Hey, today I'm gonna speak on the three holy grail of trading. That is when to enter a trade, when to exit a trade, and where to put stop loss. Now, price action trading is a beautiful method and extremely simple, but only if you get those three things right. And here's how it's done. So let's start with the entry, the most simple part. So when we are trading in a pattern like this is a channel pattern. The entry is quite obvious. Whenever it touches the bottom, you buy it and then it goes up, and you sell it once it hits the top. Quite simple, right? But here's where many go wrong. So if you see here, it's quite a similar pattern. Every time it touches the bottom, it spikes back up. You notice this repetition. If you buy it in the bottom, it goes up. So you finally decide to buy it here, but ooh, it goes down. Now here's what went wrong. So if you see here, every time it hit the bottom, it forms a strong green candle and then it goes up. Here another strong green candle and it goes up. Here strong green candle, and here as well a strong green candle. But when you thought of buying it here, there was no strong green candle here. Hence, this isn't the right place to enter. In case of channel patterns like this, which isn't so big, we can wait for the confirmation in the hourly time frame. So here in the 1 hour time frame, I get a strong confirmation and I'll take the trade. Well, similar to a channel pattern, we have here a triangle pattern. The triangle pattern here is not fully formed yet, but when it is formed, it should look like this. And if you notice, similar to a channel pattern, we can also buy whenever it hits the bottom and short it when it hits the top. So I saw that opportunity in this triangle. It hit the bottom, formed a reversal candle in the daily time frame, and just few minutes before the market closed, I took this trade. So that's how you enter a trade. The same concept applies for breakouts as well. You wait for a candle to close strong and you take the trade. Okay, let's not stretch so much on the entry. I have so many more points to speak on: when to exit a trade and where to place stop loss. Alright, let's speak on when to exit a trade. In a triangle pattern, the length of a breakout is usually the same as the length of the triangle's base. If we measure the length of a base, here it is 90%. Hence the size of the breakout should also be more or less 90%. It's done about 70% so far. Maybe it has little more room to go up, but it's always better to keep your target little less than the expected length. As many are aware, people will exit a trade rapidly when it comes close to 90%. So to avoid the downfall, it's best to exit a bit earlier as compared to the length of the triangle. Very similar to the triangle pattern is the flag pattern, but instead of measuring the base, you measure the length of its pole, which in this case is about 32%. So if there is a breakout, it can be expected to be about 32%. The triangle and the flag pattern has a method to determine the size of a breakout. But in the case of a channel pattern, there isn't quite an exact way to know how big would the breakout be. But what we do know is the bigger the channel, the bigger the breakout can be. Okay, that is entry and exit. It's actually quite simple where to enter a trade and where to exit. A slightly more challenging part is the stop loss. The reason a stop loss is quite tricky is because even if everything is going according to plan and the candle took a smooth reversal, you got a good entry, but then something happens in the market and Nifty drops 200 or 300 points, then there is a high chance the price would slip down for a while. But these are external factors and we can't control that. The max we can do is be aware if any big change is taking place that can have an impact on the market, like elections or anything that can affect the market. We gotta be cautious and try to avoid taking trades at times like that. Now, what we do have control over is internal factors. If you can see here, this is a quite stable stock and the stop loss need not be more than 2%. But in a stock like this, by just looking at how long the wicks are, you can see how volatile the stock is. Over here, the wick is 8%, and the only time it makes sense to risk 8% is if you are expecting a target of at least 24%. Always take trades only if your target is 3 times compared to your stop loss. Now, when it comes to placing a stop loss for a breakout, you need to keep your stop loss below an area of value. So, in this case, this would be your area of value, which is a stop loss of about 8%. So I'm not seeing it as, oh my god, it's 8%, I can't risk so much. What I am seeing is I am risking 8% for a target of roughly 90%. And if you feel 8% is too much to risk, you can always reduce your quantity. 8% of 136 rupees is about 10 rupees. And if the max you can risk in a trade is 200 rupees, then buy only 20 shares. The quantity of shares you take should always be dependent on how much you're risking in a trade. And the reason you have to give it some space is, in case it has to retest, it would touch here around the area of value and then go back up. So if you have a look at this breakout, just before the breakout, there was this congestion or a build up over here. This is our area of value. And if we extend it, you will see that even though there was a retest, it didn't go below our area of value. Here we are risking about 5% for more than 20%. Well, that's how you place a stop loss. For the ones who are watching right now, I know it's not easy learning so much of new information in one stretch, but the fact that you sat here till the very end of the video makes me believe you are gonna do great. So thank you so much for watching, and if you feel you haven't had enough, there are plenty of more videos in my channels on breakout strategies or best intraday strategies I have used, and many more. Do subscribe as plenty more mind-blowing videos coming soon.